Something strange is happening on Wall Street. After years of skepticism, major banks, the same ones that once called Bitcoin a scam, are quietly buying again. Why are institutional giants suddenly stocking up on crypto in 2025? What do they know that regular investors don't? Today, we'll uncover the real reason traditional finance is returning to Bitcoin, and what this could mean for your portfolio. Just a few years ago, banks like JPMorgan, Goldman Sachs, and HSBC publicly dismissed Bitcoin as too volatile and too risky. Then came the crash, and it seemed like they were right. Billions were wiped out, crypto firms collapsed, and regulators cracked down. But in 2025, the narrative has quietly changed. While retail investors moved on, institutions started buying back through ETFs, custodial services, and digital asset divisions. According to Bloomberg and ARK Invest data, institutional wallets have seen over $6 billion in new inflows since mid-2024, much of it from banks and asset managers. BlackRock's Bitcoin ETF alone crossed $30 billion in assets under management, surpassing silver ETFs for the first time in history. Meanwhile, JPMorgan now offers Bitcoin exposure through its private banking arm, and Deutsche Bank has started digital custody services for crypto clients. So what changed? The answer lies in three global forces: inflation, tokenization, and institutional FOMO. Keycap 1 inflation remains sticky, even as central banks slow rate hikes. Bitcoin's fixed supply suddenly looks attractive again as digital gold. Keycap 2 the rise of tokenized assets, from real estate to treasury bonds, has normalized blockchain adoption. Keycap 3 and with the launch of regulated ETFs, Bitcoin finally feels safe enough for banks to enter without direct exposure risk. Here's what's fueling the bullish case. Nearly 70% of Bitcoin is now held by long-term holders. Combine that with institutional accumulation, and you get what analysts call a supply shock. Every time ETFs or banks buy, less Bitcoin circulates on exchanges, making it scarcer and potentially more valuable. That's why some analysts, including ARK's Cathie Wood, predict Bitcoin could test $150,000 by 2026 if these flows continue. There's also a geopolitical twist. As BRICS nations push for alternatives to the US dollar, Western banks see Bitcoin as a hedge, not against stocks, but against currency shifts. When global institutions start holding Bitcoin alongside gold, it signals something deeper, a shift in how financial power is stored. But before you rush to buy, remember, this isn't without risk. Regulation remains unclear in Europe and the US. The SEC continues to investigate certain exchanges, and governments are pushing for more crypto tax oversight. Volatility will remain, but the difference now is that institutions can stomach it, while retail panic sells. So what does all this mean for investors like you? It means Bitcoin is no longer just a speculative trade, it's becoming a strategic asset. The smartest move might be gradual exposure, through regulated ETFs or diversified portfolios, instead of all-in speculation. When banks quietly start doing what they once mocked, it's usually a sign something bigger is coming. So ask yourself, are you following the headlines or following the money? This is Next Gen Finance, where we decode the future of money, one story at a time. Don't forget to like, subscribe, and share this video with someone who still thinks Bitcoin is dead.